Solar energy is a growing market. Improvements in hardware have led to some people predicting that solar energy will be powering the entire world within the next few decades. Regardless of whether that's true, undoubtedly a large percentage of our current energy infrastructure will be replaced by solar in the near future. And replacing our old, inefficient power grid requires massive capital investment. On Software Engineering Daily, the resources that we usually talk about are memory, bandwidth, storage, and other computer science concepts. Today, David Reiss joins us to talk about energy and financial capital, which are resources that are so fundamental that we usually don't even consider them. But we do also talk about software. David is the CTO of Wunder Capital, a fintech company that facilitates investments in solar power. It's a really fascinating conversation that is kind of off the beaten path of Software Engineering Daily, but I do try to stay to the roots of the show and talk about software engineering where it's relevant. If you enjoyed today's show, please share it on Twitter or Facebook, or share your favorite episodes with your friends. Word of mouth is the way that this show grows, and growth leads to revenue. Revenue leads to reinvestment in the show. And if you have any ideas for the show or feedback, you can always send me an email. softwareengineeringdaily@gmail.com is my janky email address. I'm always looking for new show ideas. So thanks for listening to the show, and I hope you enjoy it. I had a crazy idea a couple weeks ago. It's a photo sharing app that only has pictures of cats. When I finish my photo sharing cat application, I will be deploying it to Linode because Linode is the fastest hosted Linux provider. I don't want to get locked into a proprietary platform that's going to overcharge me as soon as my app gets popular. I just want a fast Linux server with simple pricing. Go to linode.com/sedaily and get $20 in free credit today. Plans start at $10 a month. So my free $20 will be plenty to launch my cat photo sharing app. Once I need to scale, I can use tools like node balancers and backups, and Linode has built-in dashboarding and metrics so that I can see the traffic to my Linode servers, and I can understand how many of my users are posting cat pictures and looking at each other's cat pictures. Go to linode.com/sedaily and get $20 in free credit today. The plans start at $10 a month, so it's a great deal. Thanks to Linode for sponsoring Software Engineering Daily. Now let's get on to this episode. David Reiss is the CTO of Wunder Capital, a company that lets retail investors put money into solar projects. David, welcome to Software Engineering Daily.
Awesome. Thanks for having me.
This show is typically about software engineering, and we really tried not to stray very far from that focus. But energy is a limited resource, and the amount of energy that's available and the type of energy infrastructure that we have puts limitations on the types of products that we build. And ultimately, the types of products that we build drive the types of software that we write. So I want to get into all of that, the software components, the software engineering components, but since most of the listeners don't know anything about the world of energy production, I don't think, let's start by talking about that. So there is huge growth in the solar industry right now. What are the biggest drivers of the growth of solar?
Absolutely. Yeah. So it's a really exciting time in the industry. I think we have been hearing about solar now for several decades, and it's been kind of, I think, to some greater or lesser degree over the last couple of decades, vaporware, I suppose. But it's really kind of coming of age. And the primary drivers, it's a great question. The primary drivers are hardware costs, which have been coming down reliably over the last decade or so. We're seeing roughly 8 to 10% of your cost reductions annually from equipment manufacturers. And I think the thing that is often lost when people talk about energy, the energy industry in general, is that energy is the ultimate commodity, and everything pivots on sort of the cost of energy. So it doesn't matter how cool your brand new solar energy technology is. The only thing ultimately that matters when you're talking about getting equipment deployed at scale is the effective cost of the energy that equipment is capable of producing. So that's one of the primary drivers. The other primary driver is financing, and that's what we do. So if you look at what's happened so there's three kind of primary sectors within solar in particular. There's residential, there's commercial, and then there's utility scale. Utility scale projects are something like 20 to hundreds of millions of dollars built out in the desert, and they're kind of their own ball game in and of themselves. Residential is where we've seen really a lot of growth over the last few years in particular. Probably some of these companies like Solar City and Vivint. These are very large companies, publicly traded. There are a couple of different models within the industry, but the primary sort of, the common denominator across all of them is that the growth that we've seen over the last 5 years, especially 5 to 10 years, is really the availability of financing. Solar is an asset that is just begging to be financed. It has about a 30-year lifespan, so it generates value over that time frame, but it does have a pretty large upfront capital cost. And so that's how we've seen a lot of that growth be fueled.
So I get that it sounds like there's two main drivers. There's the hardware improvements as well as the improvements to capital. And I want to get into the capital part eventually, but let's talk a little more about the broader scope. So what percentage of our energy consumption today is solar?
Right. So a very, very tiny fraction. It's difficult to pinpoint an exact number on it. There's pretty good stats in terms of what what grid scale energy is looking like, but overall it's a tiny fraction. It's less than 1% of our overall, our global energy consumption. And, that's a figure that we expect to grow to, hopefully a plurality, if not a majority over the next couple of decades.
Yeah, and Ray Kurzweil recently said that solar energy is going to power the entire world within 12 years. And his thinking on this, like his thinking on everything, is that the growth of solar is exponential, just like processing power. We know that processing power doubles roughly every 18 to 24 months. I mean, what do you think of this exponential prediction? What are the factors that are contributing to solar energy production potentially doubling its market share every 2 years?
Yeah. So, obviously we all know Ray Kurzweil loves his exponentials. And I would absolutely love for that to be the case. I think we're going to see extremely rapid growth within the industry. And I think that, ultimately the primary driver is going to be economic motivations. Right now, so, solar is kind of exiting this phase where, if you step back 5 to 7 years, it was still kind of a luxury, sort of energy production mechanism, right? So it was something that, the federal and state governments were really pushing utilities to adopt. And it was something that wealthy homeowners were putting on their roofs. And there, we obviously know there's a lot of benefits with carbon neutral forms of power. But that's really changing. And now, we're at a point where we don't actually, so us personally, we won't finance systems where the beneficiary of the system isn't saving at least 10%. And so people are doing this because they're saving money. And I think the thing that's important to bear in mind there is that people are doing it now because they're saving money, and that makes sense. But that's going to change from something where it makes sense to where it's indefensible not to do it, right? Like you're saving a little bit of money today, but as those costs continue to come down, and there's other constituent costs, like, we can obviously get into some of this, but financing is relatively expensive today compared to where we think it will ultimately be in the long term, because solar is still seen by the capital markets as a bit of an exotic asset. And so as those sort of tides start to turn and all of these constituent costs that go into building a system come down, it's going to be an extremely compelling case. And we're going to, it's going to, and this is all happening in an environment where energy is reliably getting increasingly expensive from the utilities. And there's a couple of drivers for that.
Okay, so let's talk about the technology side of things, and then we'll get into the financing side of things. So you said that hardware improvements are one of the components that are leading to this growth in solar, but with improved hardware, you get improved software. You at least get improved opportunities for software. How is that intersection of hardware and software making solar power more viable?
That's a really good question. I think that when we look at kind of the raw energy equipment landscape, there is definitely opportunity for software to play in that space. There's a lot of companies, early stage companies now that are developing kind of optimization infrastructure for integrating these what are called sort of they're behind the meter systems, so the systems that sit on rooftops that sort of serve a specific building, and optimizing that kind of that energy consumption at the building level. But certainly, and this may be sort of biased, from our perspective and the way that we kind of view this market, but where we really think that there is a huge amount of opportunity for software to play is really all of the enabling that has to happen. It's all fine and dandy to have great technology that efficiently produces energy, cleanly produces energy, produces inexpensive energy, but we need to be able to get that equipment deployed, and we need to do it at an astronomical scale. I mean, we're talking about trillions of dollars of infrastructure that need to be deployed. And there's a lot that goes into that. So, if you read a lot of the research that's being done by some of the national labs around kind of what future kind of improvements we're likely to see in terms of the solar cost basis, there's a lot of focus on things like customer acquisition cost. There's a bunch of companies that are working on that, trying to drive that down. I'd say, like, even more generally, if you look at kind of the way the system is, or way the industry is architected today, it's kind of, it's a byproduct of its own legacy, in the sense that you've got kind of some of the leading 800-pound gorillas in the space, and they own significant market share. But within the U.S., depending on kind of who you ask, there's anywhere between 1,500 and 5,000 different solar installers. And so there's a really long tail of companies that are out on roofs, bolting panels onto buildings. And those companies today are doing a lot of things that are not construction. These are fundamentally contractors. I mean, a lot of these are electricians who have grown their business and have kind of developed a specialization in solar, or general contractors that have kind of pivoted into solar or expanded their offering to include solar. And there's a lot of things that these companies are doing that they're not really particularly great at doing. And it's not necessarily something that's really kind of down the middle of the fairway for them. They're doing it as a matter of necessity, just as a byproduct of, this industry being nascent. So I think there's a lot of opportunity for software to be built to help these companies do things that are kind of ancillary to the actual system design and installation.
And when I think about the enablers of the software, I think about sensors and the dramatically lowering cost of sensors and the improved back-end infrastructure to ingest all of the data that's coming off of that sensor and perform actions based on it. Is that relevant in this context? Like, is it important to have, I mean, are these solar panels getting smarter? Are these sensors playing an important role?
That's that's a really, really interesting question and kind of point that you're making there. And I think the answer is absolutely yes. It's crucial. From a kind of a tactical perspective, there's, for us, there's a role that sensor data plays or has. It doesn't play today, but it will in the relatively near future play, which is that some of these financing structures. A lot of people talk about kind of distributed utilities. They talk about SolarCity, for example, as a distributed utility. And what they mean by that is that SolarCity owns a bunch of arrays that sit on people's roofs, and then they're selling the power from those arrays to the people that live in those houses or work in those buildings. And in order to do that, in order to finance under that structure, you need to be able to, monitor system output. You own the system, so if it's not performing properly, you need to be able to send crews out to work on it. And so there's a lot of value in that. I'd say more broadly, and perhaps the more interesting kind of aspect of the role that sensor data plays in our kind of evolving energy infrastructure is, I think, the role that I would assert utilities are currently failing to play. There's been a lot of conversation, a lot of excitement over the last 5 or 10 years about smart grid technology, and it's more or less gone nowhere. We haven't seen really any meaningful innovation in that space. I think a lot of the technology that's been deployed has kind of fallen flat, and
because it's very siloed, right?
Yeah, and you've got kind of pretty complicated relationships between the different stakeholders in the grid space. So the relationship that the utility has with, there's some entities that manage kind of the flows of energy on the broader grid, on the broader transmission infrastructure, and building, for example, marketplaces that allow a truly smart grid to function. It's a non-trivial problem. It's not an impossible problem. It's I would say it's absolutely a solvable problem, but it's a problem that takes sort of real technology prowess to solve. I would assert, and the current entities that sort of, I guess, as a society, we're asking to solve that problem are the utilities, and utilities are not technology companies. They don't have technology in their DNA. They don't know how to build technology. They really struggle to even procure technology. The infrastructure that they are operating and maintaining is fundamentally sort of 100-year-old infrastructure. And so I think there's a huge opportunity for kind of a 21st century company to come along and, sort of solve some of those problems in a way where software is really kind of a first order citizen, where it's not seen as an implementation detail, but where it's seen as the true enabler. And I think if you look at the broader conversation around smart grid, it kind of, you can approximate it as a move from this centralized kind of top-down command and control style energy infrastructure, which is what we have today. Literally, you have people in offices. For example, in California, you have the California Independent System Operator, which manages all transmission and distribution, or all transmission throughout the state, and then you have utilities that manage distribution within their jurisdictions.
These are like telephone switchboard operators.
That's exactly right, and the way that they sort of optimize and run the system is based on modeling. They have these unbelievably complex models that are used to basically analyze how the system is likely to respond to different changes. And fundamentally, we know that is a brittle system. We know that anytime you have centralized intelligence, you often have many single points of failure. And not to mention that if you try to, it's difficult to optimize those systems today. If you add a whole bunch of new variables to that system, i.e., a whole bunch of new generators on rooftops across the state or the country, that optimization becomes it's an N+1 problem. It becomes quickly orders of magnitude more complicated. And so there's this. I think it's not clear how we get there, but I think that there's a lot of people who are interested in kind of trying to push some of that intelligence out to the grid edge, which is a pattern that is reminiscent of obviously what we saw with internet architecture.
I think that Enron was trying to solve this problem by kind of like crowdsourcing the demand from the free market. I mean, they obviously weren't doing it with solar, but they were kind of trying to solve the grid distribution or equilibration problem. But they were obviously trying to boil the ocean. But more concretely or more probabilistically, we will get to this smart grid landscape where we have sensors and strong feedback loops and data streams that make sense, and then there'll be plenty of room for data science and machine learning, and we'll get these humans out of the loop. So what is that going to look like? What are the areas of waste that we're going to be able to eliminate? Is it just about eliminating humans from the process, these switchboard operators, or are there places in the grid where we're just like losing energy for no reason?
Yeah, I mean, so what my mind when I think about this problem, first and foremost goes to robustness and security. more so than kind of energy optimization. I think that it's an interesting point, and it's an interesting question. How do we view kind of, I suppose, energy in terms of scarcity? So a lot of what we're doing today revolves around this idea that energy is scarce, whether or not that's something that's explicitly stated or not. It's kind of implicit in sort of the focus that regulators and policymakers have placed on energy efficiency. And it's hard for me to say anything bad about energy efficiency. Obviously, if you can do more with one unit of energy, that's better than doing less with it. And it's also worth noting that the reality of 2016 is that we do live in a world where energy is scarce. But a lot of what, when we were sort of first starting this company, we were looking for a way to kind of we were looking for a lever to pull against this problem that wasn't necessarily predicated on scarcity. We kind of solve that underlying problem first. If you challenge the notion that energy must be scarce, then some of these other things go away, and you can start to focus on things like robustness and security. Well, I mean, you should be focusing on those today, regardless. But obviously, we have huge vulnerabilities in our grid today. But yeah, I mean, in terms of getting humans out of the loop, I think there's a lot. I would say that it probably, it's a difficult question to answer because I think it's very difficult to predict exactly how this ecosystem is going to evolve. But certainly one of the ways that I expect removing humans will be of significant value is that we're able to do more types of kind of real-time automated bidding processes so that energy is accurately priced. Does that kind of make sense?
Yeah, absolutely. So one way or another, what is clear is that the infrastructure that we have is decrepit and it's wasteful in one way or another, and it is going to be replaced. And the goal of Wunder Capital is to facilitate that energy infrastructure improvement, revamping, replacement, facilitate it by improving and increasing the flow of capital. So let's move into a conversation about how this works. So I read a post on the Wunder Capital blog about this, why commercial solar needs fintech. And you basically laid out, how much infrastructure there is that needs to be revamped. This entire old world utility grid, non-smart grid. And the thrust of the post that I read was that the solar installations for residential scale, which is like the Solar City type of places, and then for utility scale, those segments are doing fine. The investments are happening. The capital is getting allocated, but the commercial solar market is not developing as quickly as it could, and the commercial solar market is huge. And the reason that the commercial solar market is not evolving as quickly is because these commercial investments, they're more like one-off investments, and the investments require a lot of diligence. And because commercial solar investment is different in contrast to the residential scale or the utility scale, which are pretty homogeneous, it's more complex to get people to invest in them. So commercial solar, explain why commercial solar power makes for more complex investments than residential solar or utility scale solar.
Absolutely. And by the way, that's an excellent synopsis. So first of all, it's not more complex than utility scale. The reason that utility scale doesn't suffer from this is simply because of its scale. So if you're doing a $100 million investment out in the desert, you can afford to spend significant amounts of money on transactions, right? You can have dedicated teams, analysts, et cetera. Now, compared to residential, there's a couple things at play. One simply is that for homeowners, the transaction is a lot like, signing up for a cell phone service from Verizon or something like that. There's some contracts that, an installer or SolarCity or Vivint or one of these big players will put down on your dining room table. You sign them, and that's kind of the deal. There's no expectation that they're negotiated. The terms are pretty standard and pretty fair. And if you contrast that to commercial, now you're dealing with entities that have legal counsel, generally speaking, and so it's much more difficult to get contracts executed in kind of one pass. There's more of an expectation around negotiation. And that's also kind of a byproduct of the fact that commercial contracts are very non-standard. There's not a lot of, they have not coalesced within the industry, and there's rarely do we see two contracts from two different installers that look really anything alike. And so there's a standardization issue that I think a lot of people have focused on recently. But more generally, there's also just a lot more complexity to getting those deals done. And so that's something that we've been working on getting pretty smart about. The other thing, and that's I think a bit of a harder problem, is the way that investors view solar investment risk. And so the reason that capital is available for residential systems is primarily because there's ubiquitous credit on which that capital can be distributed. So essentially what happens is you have some type of entity that goes out and secures a tranche of financing from a financial institution. And that financial institution says, basically, go and deploy this capital to finance systems for homeowners that have a FICO score of 680 or above, or 690 or above. And they kind of give them this box. Here are the zip codes that you can use this capital in. Here, and it mostly, though, focuses on what's called off-taker credit, which just means the creditworthiness of the borrower, or the off-taker, depending on the financial structure. It's not always a debt structure. And that's a bit problematic, because if you think about fundamentally what FICO is, it is a sort of general purpose credit risk proxy. And solar investment risk has a very specific set of risks, some of which do relate to the creditworthiness of the customer, but not all of which do. There's actually really good recourse for recovering value from financings that have entered into default. And so anyway, needless to say, regardless of how good that risk analysis is, that exists, and it allows capital to flow. That FICO equivalent doesn't exist within commercial. You only really start to get reliable credit scores at very large scale. So you can, Walmart has a credit score. You can go to Dun & Bradstreet and ask them how credible Walmart is, and they'll tell you very credible. But if you go down market and you start looking at even relatively large companies like $20, $30 million run rate companies that are maybe local businesses, local manufacturing facilities, things like that, you oftentimes don't see very thick credit profiles, which makes it very difficult to extend financing in the way that works for residential. And so there's a couple of reasons for that. It's generally referred to as the small business lending problem, although it applies to medium-sized businesses as well. And there's a couple of companies out there that are explicitly trying to address that for the purposes of extending general purpose credit. What we're doing is not trying to necessarily address that problem explicitly, but trying to do a much better job of characterizing sort of the solar attributes of the investment risk. And so, we're still looking at credit, and we look for what we call bankable credit, but it's not the only thing that we care about. And that really enables us to look much more deeply into the commercial market and extend financing to many more businesses.
Okay, so let's start to talk about that. If I'm working on a commercial solar project and I want my project to be funded using investment from people who are on Wunder Capital, explain how that works. Explain how this two-sided marketplace works. Yeah, absolutely.
So, on the capital side, we have funds, and so they're rolling funds. We're continuously out, trying to get new investors into the funds and raising capital into the funds. Once we have, and the way that works essentially is that investors, it's not an equity investment like you might see, venture capitalists making in an early stage company or something like that. It's a debt investment. It's actually a very similar structure to Lending Club and to Prosper, but it is what's called a non-recourse payment dependent note, which is effectively a loan that the investor makes to our fund. And then once we have that capital, we have this on the other side of the marketplace. We have an operations team that has established pretty close working relationships with around 70 or so installers across the country. And so those installers, and this is kind of, I alluded to this a little bit earlier, but under the current paradigm of the industry, those installers are the ones that are out in the marketplace trying to sell commercial deals. And most of them actually have pretty established residential practices and then are also doing kind of commercial because they're generally much more lucrative projects than are the residential projects, or more specifically, there's a set of fixed costs associated, and doing, commercial projects tend to be about 20 times bigger than residential. So for the work of doing one project, you can do what would otherwise take you 20 residential projects to generate in terms of revenue. In any event, these guys are out selling projects. When they've kind of sold a project, oftentimes they'll bring financing to the table. That's us. And then we start to we evaluate the project and determine whether or not it's a good fit for our financing. And there are, at this point, roughly 350 variables that we evaluate across the project. And there's a range of different types of analysis. Some of it's very subjective, some of it's very objective. But I can tell you that the primary thrust of the evaluation that we do is focused around the energy economics. And so when we look at making an investment or extending a loan to a commercial solar project, what we're really looking at is the project, the array itself doesn't have any intrinsic value. The value of the array is the energy that it produces over its lifespan. And so we're looking at what is the value of that energy over its lifespan, and then what is the recoverable value, and that kind of determines essentially what the collateral value of the system represents to us. And then we look at some other things, we mix them together. We look at the creditworthiness of the borrower. We look at vacancy risk. We look at we do some modeling to estimate what sort of median duration of vacancy would be like in this environment. We look at how sort of desirable the commercial property is. And essentially what we try to do is try to paint a picture of, okay, if we're going to be generating energy out of this system for 30 years, how many of those years is that building going to be occupied? And from that, we can kind of determine, how healthy, how robust of an investment, a particular project is.
So let me see if I've got this correct. So a potential investment comes on the platform, and you look at that investment in terms of around 650 variables. And those 650 variables are guidelines that assess the economic worth of that investment, the projected economic worth of that investment. So it might be an array of solar panels out in the boonies somewhere where there's no development, but there is on a 30-year time horizon, there's projected massive development in the area. So there's projected increased demand for that energy. So therefore, you can be able on, if you're looking at it on a 30-year time horizon, and you're looking across the world on a 30-year time horizon, you will have a rolling improvement in your machine learning model for for what makes a good solar investment based on the economics. Is that am I describing it correctly?
That's mostly correct. So just to be clear, we don't everything that we do is rooftop. Essentially, it's all what's called behind the meter. So it's all located in situ. And so I think the one thing that's important to connect the dots on is that we won't generally finance a system that's out in the boonies. We generally want systems that are essentially sit on top of high value real estate, right? And the reason for that, and also the way that we define what is high value real estate, it's not high end, it's high value, is essentially how likely is this building to stay occupied over a longer term time horizon. And so it's important to note, there are obviously ways to sell power back to the grid. There are obviously ways to, there's several different mechanisms for that. The most common of which is net metering. There's virtual net metering. There's a couple different sort of regulatory constructs that allow people who own assets that are underutilized to feed power back. But those are subject to what we call regulatory risk. And so, like, if the political or regulatory winds change, those policies may very well go away, and our ability to generate revenue using those mechanisms may go away as well. And so what won't go away is if we have a system on somebody's roof if there's somebody in that building, we're pretty sure that they're going to be consuming electricity. And if they're consuming electricity, we're going to be able to sell that power to them at a rate less than what the utility will charge. So I guess, that's generally correct. I think the other thing to note is, definitely this kind of evaluation process, we have kind of two sides to the platform. We have a kind of a borrower side and investor side. They're a little bit isolated in the sense that investors are not investing in specific projects. They're investing in a pool of projects, and that diversifies their risk. But it also eases some of the kind of what we call capital matching challenges between the supply side and the demand side in terms of financing. So we can sort of smooth out some of those ripples.
Software engineers are always looking to automate their work. Software automation lets us get more done with the same number of resources. Investment automation works the same way. Wealthfront is an automated investment service that relies solely on software to acquire and manage client accounts. Traditional investment services have many humans in the loop, advising clients and taking fees. The problem with these older advisory services is that the advice that these services are applying is often so systematic that a computer could give the same answer, or an even better answer. Wealthfront takes a new approach with software-driven automated investment that provides better returns through software engineering. Go to wealthfront.com/SE daily to get a special offer for our listeners. $15,000 managed for free when you open your account. Don't pay commissions and account fees. Maximize your gains with Wealthfront's set it and forget it investment automation. Check out wealthfront.com/SE daily. It would support Software Engineering Daily, and it would also introduce you to the world of automated investment, so you can see if you like it or not. Wealthfront.com/SE daily. Thanks to Wealthfront for sponsoring the show. You've been a loyal sponsor, and we really appreciate it. Now let's get on with the show. So how important is the machine learning component of it today? Because to me, it seems like, so even if you subtract machine learning from it, you have a fintech platform where people can invest in a sensible investment, and I can see that having value in and of itself. The machine learning component seems like maybe it could work like over a longer time frame, but today, it seems like the problem is just so complex that it doesn't seem to me like a good application of machine learning. Am I wrong about that?
So a couple things of that. I mean, no, you're not wrong. So first of all, like the problem is multifaceted, and I've kind of come up with some new language to describe that. I've found recently that I hate describing problems as complex because I think it implicitly leads you to solution spaces that imply complexity. And so, yeah, there's definitely our stack covers a really actually pretty broad set of domains. Any given domain, so like the economic analysis that we're doing on energy economics, yeah, that definitely has complexity. It's not the type of thing that you can spin up on in 12 hours. But it's also not rocket science. It's at the end of the day, it's fundamentals based, and it everything that we do, we endeavor to reason from first principles. And so I think from that perspective, we are, and I also to kind of more directly answer your question, like we are not yet at a scale where we have the necessary training data to actually automate a lot of this process. But that is the direction that we're going. We're also not really actually trying to automate it entirely. We are sort of pursuing, what I often refer to as kind of like a PayPal fraud or a Palantir style approach, which is let's automate as much as we can. Let's not try to eliminate the humans. Let's just try to optimize their cycles. And so we're talking about, automating, 85 to 95% of our underwriting process, but then just making our operations team really as efficient as possible at evaluating these systems. And so, we're definitely a ways off from being able to sort of really dig in on kind of some of the algorithmic and automated, or maybe more specifically, the automated algorithmic aspects of the underwriting. But we're definitely on a track to get there. I mean, to give you kind of a sense of where we're headed, this year we'll probably do something on the order of about 50 deals. Next year we're going to try to 10x that. And internally, when we talk about the infrastructure that we're building, we're talking about doing 10 to 20,000 deals a year. That's kind of the system that we're designing for. And so that kind of puts a bounding box around the extent to which we need automation, both kind of the upper bound and the lower bound, and what types of things we can sort of continue to do manually, I suppose, at scale. The final thing I'll comment on that is we're following a very much, I'm a big fan of some of PG's essays, as I think many people are. And we are definitely doing unscalable things, which is one of my favorites of his. And so, we have our operations team doing things the hard way. Some of the process is really ugly. Some of it's across a bunch of different spreadsheets, and we've got a bunch of scripts that we, run down at meetings when we're evaluating deals. And that's all for the sake of rapid iteration. So we want to really try to zero in on our problem domain and get a pretty firm understanding of that. And then it's incumbent upon the engineering team to deeply understand how that came to be, and start to explore the solution space that allows us to kind of address some of those issues.
So that makes a ton of sense to me. Like we're at this place where, over the next 10 years, if Ray Kurzweil is right, then the flywheel is really going to start spinning on improved speed of investment. There will be more investments. Maybe Wunder Capital can get access to data on investments, even ones that aren't made on the platform. So these 650 variables start to get better understood, which ones correlate with a strong investment. But in that scenario, where the model starts to really come into resolution, are there still existential risks to that model? For example, let's say self-driving cars come online and it totally changes the grid, or the Uberization of deliveries and stuff totally change the demand. Drones could change the energy demand. Or maybe I'm overestimating how much that would actually affect energy demand. And I guess maybe I'm also potentially overestimating how important this model creation is to the platform itself. But is that a concern at all, that you could build this model and the model would be based off of premises that might no longer be true all of a sudden if self-driving cars come online or drones come online or whatever else?
Yeah. So, I mean, I think that there are always sort of risks associated with kind of, a changing sort of, just changing landscape of society, right? As some of these technologies, come to kind of mature, right? I think, though, I guess there's a couple things there. One is, I think it's important, and I don't know if this is the observation that you're making with those examples, but oftentimes people conflate transportation energy with grid scale energy or non-transportation energy. And as far as we're concerned, the electrification of transport is only going to do really good things for our position in the market and for distributed energy in general. The overwhelmingly transportation fuels are oil-based, liquid-based fuels, and that a lot of that demand is going to be shifting to the grid or the distributed grid, right? And so that is obviously going to drive additional demand for the type of infrastructure that we're building. I guess more generally, though, there's absolutely potential for certain types of, like anybody who is investing in, building stores for big box retailers to occupy, 5 or 10 years ago is probably not doing so great right now, right? So obviously, those sort of, once that last mile delivery, once that gap closes, there's obviously kind of a changing that has implications for the demand for warehouse space and things like that. And so we definitely take into consideration as much of those variables as possible. But ultimately, we are, our bet is, I guess, in a sense, there are aspects of it that are kind of informed by sort of trends towards urbanization. Population density in the region is something that we take into consideration when we're looking at investments. And so, it's not an overwhelming concern because we think that the demand for energy sort of at the plug, so to speak, is really only going to increase, whether that additional demand is going to come from EVs or really just new technology in general. And, people talk sometimes about sort of other types of existential risks around, okay, let's just speak in gross hypotheticals and say we bring fusion online in the near future, which, I think we'll do it. I just don't know whether it's going to happen in the next century. But regardless, even if you were to do that, the only type of fusion that would, of course, speaking in a very theoretical sense here, the only type of fusion that would really have an impact on us is distributed fusion. Because even if you were to drive the marginal cost of power at a centralized energy generation facility to zero, the fixed cost, or rather the marginal cost of that power does not affect the transmission and distribution cost, which is very significant. So transmission and distribution, i.e. getting power from a centralized generation facility to a household or to a commercial business, that sometimes can reach 50 to 60% of the actual cost power at the plug. And so that's kind of the floor that we're competing with. And I think we actually have line of sight to solar being competitive with transmission and distribution costs alone, not to mention whatever incremental costs are associated with the primary fuel, which is, for centralized grid applications is overwhelmingly hydrocarbon based and and most often natural gas.
Okay, so I like that response because I think what I was getting at was that there are these potential macro trends that maybe they're an existential risk to the model that Wunder Capital is developing, but how you address that is basically most of the macroscopic existential risks are actually they're not risks, they're things that would potentially be boosters of the Wunder Capital vision of the future or accelerants. So we should talk some about software since we're already most of the way through this conversation.
Absolutely.
I'd love to know some about the software architecture and what are the things that are important to keep in mind at Wunder Capital. I know that you started as a monolith. You've more recently moved towards microservices. Maybe you could tell me about the architecture as it started and how it has evolved over time.
Yeah, absolutely. So, it's still early days for us at Wunder. We have a small team. We're growing rapidly. And, we are, I'd say, kind of as I mentioned, with that sort of do unscalable things style approach, we're trying to, as much as we can, develop a robust understanding for the actual problem that we need to solve before we really sort of sink massive resources into building scalable infrastructure, around the solutions to that problem. So I'm very, very sort of keyed into trying to not build the wrong thing. So yeah, I mean, I guess the microservices conversation is, I think it's a really interesting one. We are a monolith still, and as I mentioned, I think before, the way that I view the problem that we're solving is that it's multifaceted. It has a pretty wide range of domains. To kind of just rattle off a few, we basically had to build most of the infrastructure that you need in order to be a bank. We're not a bank, but and we use Dwolla for our ACH transactions, for our programmatic transactions. But there's a bunch of infrastructure that we had to build related to moving money, related to interacting with Dwolla's infrastructure. We have to do accounting. So we've got a whole bunch of investors. Each investment is in a different state. We need to account for all those investments. We also have accounting on the borrower side. All of the financing that we do needs it's not super complex accounting, but it's non-trivial. We've got billing infrastructure, so we need to be able to sort of invoice our our borrowers monthly. We need to be able to draw down payments from them. We need to be able to do the same for our investors, and that's calculating interest, calculating service fees, calculating all the things that you need to do in order to essentially be a lender. We have end of year compliance stuff. We have to generate tax documents for all of our investors. We have to generate some documents for our borrowers as well. Every month we're generating statements. Then of course we have the investment flow. So we only based on sort of the current sort of securities regulations under which we're issuing securities. We can only accept investment from accredited investors. So we need to be able to accredit our investors. We need to be able to verify those documents. And we need to have, we have sort of an investor portal, all the stuff that goes along with servicing investors through that portal. So I can go on, but the point is that, none of that we're doing, I don't think in isolation is really all that difficult. But it's been really interesting as we grow the team. How do we deal with that diversity of complexity and that diversity of nuance? There's a lot of nuance in all of these systems in a way that I don't think generally occurs, at least not in my experience, on early stage teams. So, if you're a 40, 50 person development team, maybe this stuff doesn't sound all that daunting, but, the reality is we're 3 people right now, and, we'll be probably 6 or 7 by the end of the year. We're actively hiring. But the reality is we are still, sort of a Series A resource constrained organization, and we're looking to run as lean as we can, as far as we can. And so the way that we've kind of dealt with this is by introducing kind of SOA within our monolith. And I think there are some people who've been talking about this. Some people refer to it as a structured monolith. There's a couple of different paradigms for how this is done, and we're definitely still kind of experimenting with some of them. But towards the beginning of the year, we started to see a lot of this complexity developing in the system. We got kind of concerned about the monolith turning into a totally unmanageable ball of mud. It was a real concern. And we went pretty far down the path of trying to see how viable it was for us to actually spin up microservices and actually break our application functionally across all of these different boundaries that were actually at that point starting to get pretty well defined. As we prepared to do that, one of the first things that we did was reduce all of the interactions between these different services to kind of really well-defined interfaces. And the first step for us to do that was to actually write the interfaces within the application. And I'm happy to expound on any of this, but the kind of long story short is that we found by doing that, we gained really, really a lot in terms of encapsulating complexity and compartmentalizing it, to the point where if you fast forward to today, where we've kind of used this process, essentially it involves breaking out microservices without the breaking out part. And so we have these well-defined interfaces. We don't have to do RPC. We don't have to do the DevOps. We don't have any DevOps load associated with having a bunch of different machines, independent scaling. We don't have intra-service authentication issues. It's all a single process. And for us, we're operating a scale right now where that's totally fine. We don't need to be able to individually scale specific services. The reality for us is that, even if you think about doing something like 20,000 deals a year, you can kind of throw metal at that problem. If you're talking about doing 100 million, okay, maybe you need to rethink that. Maybe that's kind of actual sort of Netflix scale of real-time actions.
Sure. So at your scale, you're not going to hit a fail whale anytime soon.
We don't expect to. No, certainly not.
Yeah. So it sounds like you started thinking about microservices and you ended up just refactoring your APIs.
So yeah, that's basically right. We actually kind of injected some APIs, right? Like we basically wrote the APIs that would be the APIs for the services.
Right.
But we did it within Rails, which I don't know how much you've spent, how familiar you are with the environment, but obviously it's like any other MVC framework. It doesn't really have that construct built in, right? It's something that we introduced.
Okay. In the future, basically, so it sounds like you've kind of got a style at this point where when you're ready to move to microservices, once you're at that scale, the way that your methods are defined basically will their outward facing contract will be easier to port to some other language, some other platform, whether it's like JavaScript services running on Kubernetes or whatever.
Sure. Yeah, I think that's definitely kind of in the back of our minds is this idea that kind of the work that we've done to date will make breaking these services out easier. But I think the realization was almost, it was almost that even short of that, even if hypothetically there would be no expectation to break out these services, there's a lot of value in, I think, structuring complexity in this way. And B, there's also, I think, I'd say that the most important takeaway was, and the most interesting thing for me was this idea of taking something that had, gained really a lot of momentum kind of in the software development community, i.e. microservices, and really trying to take it back down to fundamentals and be like, why are people so excited about this? Let's actually list out what are the advantages,
Communication, right?
Right, exactly. And I think, that's, you look at a lot of what people are talking about, and I think a lot of times people are focused on, the boundaries as the value that microservices provide. And I think, I don't know what the exact proportion is, but I'd say that something like, if you hold scalability as, let's say scalability isn't like a real issue, and let's be honest about that, right? Because it's like, you can actually achieve quite a lot of scale in ways that might not intuitively seem, or they are not the most elegant, for example. But if you just say scale, okay, well, let's not worry about scale. Then this boundary thing becomes the primary reason that microservices are of value. There's kind of a secondary, which is like sort of technology agnosticism, which allows you to mix and match technologies, which is pretty cool. But of varying degrees of value depending on what you're actually working on. And establishing a hard to cross boundary, it's hard to say, okay, let's be disciplined and not let context bleed from model to model or controller to controller. And so basically what we said is, well, why don't we just, you still need to be disciplined because you still can do things that break these service boundaries easily. There's nothing that stops you from, calling up for us, the example would be like pulling in, a bank namespace active record model into our accounting namespace. Like you could do that, but that would be a violation of our boundary, and that would not pass code review, right? So the idea is that you can achieve hard to cross boundaries without incurring a lot of the costs, which would be like fully async services or the dealing with kind of fault tolerance or dealing with network faults if you're talking about RPC, or just dealing with RPC, which it's not rocket science, but it's also not trivial if you're trying to really optimize for project velocity.
Interesting. I really like that. It's some serious pragmatism. Okay, so we're running towards the end of the time. So I guess I want to zoom out and given that you're talking about this, kind of maintaining the monolith as you sort of move towards fixating on what your business model is going to be. I mean, what are the potential futures for where Wunder Capital is headed? If the business model hasn't been totally fixated on, it sounds like you've got this two-sided marketplace thing right now, but it could go in a number of other directions. What are those directions?
Yeah, so I mean, I think I think broadly the direction is pretty clear. Like we're starting to get quite a lot of traction with the model that we have. It's just not exactly clear where kind of the next 10x is coming from. We're kind of testing a couple hypotheses internally right now. So I think it really has to do, I'd say the kind of the primary conversations that are being had internally that kind of have an impact on, I guess, where we go from a technological or from a technology standpoint, I think relate mostly to, where the deal structure kind of lands. And this is perhaps like a little bit nuanced in terms of the actual kind of where the rubber meets the road in terms of these financings. But our primary product to date has been a debt product. We're looking at doing a couple of different structures, and that's we've got a lot of market data on that. So they're sort of well-informed hypotheses, but it's also relatively big bet, and so there's a couple months of kind of investigation that we're doing there as we kind of solidify some of that direction. But in terms of like a day-to-day execution, the next 3 months of development are very clear. It's very clear what we need to do. I would say almost the next 6 months, it's very clear. Beyond that, anybody who's working on an early stage company, if they tell you they know what they're doing in 6 months, they're probably lying. But basically, it revolves around really structuring the deal data. So any way you slice it, we're going to need really nicely structured data about these investments so that we can start to do some of the automation that we need to do. And so the work that we're doing right now is really about laying that foundation. And that's everything from, building up, kind of extending our borrower portal to accommodate more types of deals and do a better job of kind of structuring that data input. And then sort of once that's that'll be in place in the next month or so. As that kind of crystallizes, we're going to start moving into some of the evaluation infrastructure, and we're already kind of looking at different sort of ETL methodologies. It's not clear that that's necessary at this stage yet, but we're basically looking at what is kind of the V1 sort of automation look like. How do we take it from a 2-hour-long conversation around our conference room table to a nicely structured process whereby we can automate 10 or 20 or 30% of that, moving on up to 85 or 90 over the next 12 to 18 months.
Okay, well, that's a great explanation of where the company's going, and I've really enjoyed this conversation. It touched on a lot of things that we have not explored on Software Engineering Daily. So, David, thanks for coming on the show. This has been a great conversation.
Yeah, I enjoyed it as well. Thanks for having me. I appreciate it.